Hi, it's Ethan Devitt. It's Monday morning, April 7th, and I'm coming to you with a special edition of the Markets Happy Hour podcast in light of the market developments we've had at the end of last week and over the weekend, and certainly as far as what's happening in markets today. I'm loath to call this a happy hour, as it is anything but a happy hour, but let's call it an hour of reflection and just 20 minutes of reflection at that. I'm going to show a few slides and give some insight myself as to what I think the markets are doing and why, and speak a little bit about what we know and what we know and have put in place for portfolios and how we should look at the next few weeks with those portfolios in mind. So I've called this signal and noise, and I've used this image of a lot of noise. What I would say is that there are some very clear signals emerging from this, and some of those signals are being interpreted in polar opposite ways. For example, a lower rate on the US 10-year is being interpreted in different ways, as is a lower oil price being interpreted in different ways, some positive, some negative. So let's dig into that a little so we can actually work out what this is likely to mean for investors and for consumers. I'm discussing what do we know in terms of what was the market condition preceding the recent action by President Trump. I'm going to look at the root cause of some of this market volatility. I think many of us know what that is. It is the unprecedented level of tariffs being imposed in the US. I'll look at some of that signal and noise and speak about next steps. So, what did we know? We knew that at the latest Fed meeting, we had inflation not quite subdued, ticking up very slightly. We did have it quite convincingly subdued in Europe, but we did also know that expectations were getting higher. I'd shown a chart just last Thursday showing the divergence between business investment spending and consumer inflation expectations. They were ticking upwards, most violently recently, probably because of tariff news, which was brewing. The actions on April 2nd, excuse me, were not unexpected. We knew there were some tariff news coming down the pipe. We did not know the extent of it, but all of that was driving inflation higher. And the Fed had not budged. They were staying data dependent. And there was some sense that this was the really the safeguard or the shackles that the Fed found themselves under. They could not reduce rates as they knew that inflation was not yet fully in the rear view mirror. That last mile was proving sticky. What we also did not speak about last week, but we just had the news on Friday, we knew that the jobs market was still surprisingly resilient. There had been, if we look at the chart below, that unemployment remained very much in a range that was comfortable, below 4.5%. And there was approximately 228,000 jobs added in March. So a solid number, defying expectations, ahead of expectations. I would suggest, however, that this is not necessarily a particularly positive sign for the economy going forward. It is a lagging indicator. We've already had signs of freezing and hiring, some furloughs, some layoffs already in anticipation of the effect of tariffs. So it was a sign, though, that the economy was remaining as resilient, as stubbornly resilient as it had been up to now. So that was still a good indicator. We did know that there was more growth uncertainty starting to creep into the picture. We'd seen some fairly anemic yet positive growth coming out of Europe, and expectations for US growth were starting to come down. So this was all preceding the tariff announcement. And then in terms of the Trump trade that we'd been forecasting from July of 2024, some of these things were fairly well laid out in the election manifesto and that we knew were going to be hallmarks of President Trump's policies. We suspected this would be positive for energy. We know about his drill, baby, drill initiative. And ironically, now with a lower oil price, this may not play in to a drill, baby, drill approach, may not actually be at a level that would justify drilling. We also suspected gold would be a winner. In some cases, that was because of an expectation of increased budget deficits and maybe a lack of confidence in fiat currency, but that has proven to be a winner. We knew Bitcoin cryptocurrency would have tremendous tailwinds from lack of regulation. That was also true until the risk off rally or risk off downturn in markets, which has captured Bitcoin and crypto assets just as much as anything else. And we thought it would be good for industrials. We still think it will. We knew deregulation was a tailwind. Inflation, tariffs, we expected to be inflationary. That has played out. And we also expected tax cuts. Haven't seen them yet, but we expect them to come down the line and to be stimulating. We also expected losers to be a potentially weaker US dollar. We expected that renewable energy, such as solar, would come under pressure, and it has. We thought chip stocks would be in the crosshairs of tariff movements, and they were somewhat, but ultimately not as affected as we had thought. EV manufacturers captured by some of the backlash against Biden regime subsidies. DEI, we know, has fallen, environmental regulation likely to fall. We also were looking at economic growth as potentially falling victim to tariffs, as well as US Fed independence in question, and China, which could potentially be very much in the sights of the trade wars. And that has all played out. So this has been something that we've been discussing since July 24. And markets have been showing the signs of that weakness despite an initial rally when Trump was elected. We can see these charts show that US stocks were already under pressure before last Wednesday. We know that there has been an erosion of the US stock market since Inauguration Day. Despite an initial rally, this has been the worst start to a president's term since George W. Bush. We can see the chart on the right that shows, which is the purple line being Donald Trump. The initial pro-cyclical, pro-growth rally that followed his election quickly gave way to these concerns creeping in. Most of it tariff related, some of it related to uncertainty, and some of it a reversion to the mean, a sense that European stocks would be the beneficiaries of some of this more isolationist policy on the part of the US. So all of this was already in the works. And I would suggest, however, that this new strong medicine has taken this to an entirely new level. Portfolios that we had constructed were generally constructed to cope with this kind of stock market volatility. We construct portfolios that are well diversified across value and growth, across small, mid, and large, and across US and non-US. And what we did see was that Europe and non-US markets were strongly outpacing major global indices since the inauguration, and that we had seen there was generally dominance of stocks such as defense stocks. So a change from Mag 7 and more of a reversion to the mean, more of a sense of balance and value had certainly done very well. There were other messages too suggesting that some of the strength in US markets was not froth, that it was justified because many of these large companies had fat, comfortable margins, large moats around their business, and had, because of AI, had sufficient cash piles. We're likely to be spending on AI a significant amount in capital spending. We had these charts showing that the run rate of capital spending by some of the Mag 7 was well in excess of what it had been in the run up to that. And that was giving good stimulation to the picks and shovels behind AI and the infrastructure and data centers. And these were all doing well. So I would say that this was perhaps a mixed message in markets. Despite the fact that the US was giving back some of its outperformance relative to the rest of the world, it was nonetheless was supported by fundamentals. And there was a sense that there were real revenues behind these numbers from the Mag 7, and it wasn't the sort of the non-revenue gain that we'd seen in the initial, say, internet 1.0 and some of the early dot-com booms. So something was different this time. We saw the large tech moguls rally around the new president. Expectation there was of less regulation, more favorable antitrust environment, and generally a more favorable pro-business type of a marketplace. And this, of course, the tax cuts would have factored into that. So all of this was behind the mixed messaging that was leading to a kind of US exceptionalism, but not the kind of the trenchant US exceptionalism that we'd seen leading up to this. It is safe to say that these tariffs were a big bang in their nature. The effective tariff rate that were well beyond reciprocity was putting this into historic levels in terms of tariff rates. Some of the confusion around how these tariff rates were calculated, again, added to the uncertainty. And certainly this went far and away, well ahead of the even any of the election promises around tariffs. So definitely a shock to markets. There was also a sense that when we spoke about the shock to markets, that this was some kind of a strong medicine. And I'll speak a little bit later about whether this was the kind of medicine that we needed at the time and how we can cope with some of the side effects of this medicine now that it has been administered. I think it's important quickly to talk about some of the signal and noise, because we're hearing a lot of mixed messages right now from the administration about some of the fallout of the recent market movements. And I just wanted to talk about that because I think we can interpret some of these signals in different ways. The oil price has fallen. It's that's not only due to expectations of lower growth, but also due to OPEC and supply matters, which also significantly affects oil price. This is seen as having a positive impact on the consumer and has been touted as a positive sign by members of the Trump administration. They're suggesting this will have a meaningful effect at the pump on Main Street, and it will ease inflationary pressures. This is true. However, it's suggested that the oil price falling is, while good for the consumer on one level, is a direct result of economic growth expectations collapsing. And if that is the case, it's not so much that the lower oil price can itself drive growth, but it's more of a symptom of economic growth collapsing and calamity potentially being ahead. So I would say that is ultimately sort of a small silver lining here in a cloud of economic downturn. So not particularly positive news, that signal. The US 10-year has been lower, and we know that it's below 4% now. This has been very much in Scott Bessent's focus. He has been focusing on keeping that low more so than the shorter term Fed rate. Now there is some rhetoric suggesting that this is a great win. This is how we will save refinancing costs on the large burden of government debt, that mortgage rates will be lower, that will bode well for the consumer. And again, this will ease the debt burden on companies. I'd say we should be very cautious with this suggestion. First of all, the reason the US 10-year is low is because it's a flight to safety and an expectation that we are heading in to a recession and economic weakness. So this does not necessarily lend itself to climate of rampant borrowing, refinancing of houses, house purchases. If the employment and the stability and the consumer sentiment cannot support that, or the corporate sentiment cannot support taking on levels of debt, this is going to be an issue. We should also remember that lower rates drive inflation, and we have not only inflation been driven now by tariffs, but potentially by lower rates. So there can be a danger to lower rates, which is exactly why the Fed has been so restrained in lowering rates this time around. It does not want to spark that inflationary rise again. So I would say that a US 10-year being low is a very mixed message. The final thing to say is a US 10-year being low will affect the rates savers can enjoy and cash. It will depress cash. It will also, especially if there is inflation remains high, it will drive the real rate of return potentially towards negative territory. So we need to look at the impact of that when its interest rates are lower, and similarly private credit investments, anything that in some way floating rate and attached to the underlying base rate will see lower returns. So all of this will factor in to a more challenging environment for investors, especially investors who do not want to take on a lot of leverage if the US 10-year is lower. So again, mixed message there. Finally, a weaker dollar. We've known that a weaker dollar was somewhat in the sights of the Trump administration, and certainly if rates do come down and the Fed is forced to cut rates, that would be a factor that could reduce the dollar further. I would say that a weaker dollar is, whereas it could be good for some of our trading partners, if any trade actually takes place now, and it could be good from trade from a perspective of US exporters. Trade already being with such a question mark, I'm not sure that a weaker dollar is that much helpful. And equally, it'll be negative for portfolios outside the US that are invested in US assets. So a lot of mixed messages from some of these indications. Now, as to whether the patient was indeed sick, I'd say what we're hearing the rhetoric of strong medicine, and that this is the medicine, that the surgery has been completed and there's going to be some pain, but it's a necessary medicine to take us into the next wave of health. I would say that there is an argument as to how sick the patient actually was. As I mentioned, the consumer and the economy was incredibly resilient up to now, despite COVID struggles, although that was the medicine there was, as we know, checks, and there was some very strong medicine taken to alleviate the burden of COVID. But in the aftermath of COVID, we endured a steep rate rising cycle, as well as the potential for other slowdowns to revert to the mean. And the economy and the consumer defied expectations in every case. So I would say the consumer was fairly resilient. Also, I would think that the consumer, and generally, particularly portfolios, were built towards more holistic health. there was diversification there. We had ensured there was both inflation resilience built into portfolios as well as growth drivers. So all of this was working towards having a portfolio that would be more all weather. Yes, there were inequalities. Yes, there were more citizens using food banks than ever before. Yes, there was a rising um, fiscal budget deficit that was reaching historic levels. And yes, there were some strains across various industries. And yes, there were pockets in the US that had been hollowed out industrially. But I would say that there are as many second opinions circulating as to what the appropriate medicine was. For example, cutting spending, raising taxes. These were all suggestions that could have been taken to alleviate this burden. And we know that there were two very different economic policies put in place by the two recent presidential candidates. I would suggest that this medicine is so strong that it's essentially more akin to an amputation than medicine. Because we have put in place these historic tariffs now, there is essentially, we have cut off a limb, and that limb is cheap supply. And really, what was the lifeblood of many companies, not only across the goods producing sector, but also across the service sector. It is extremely complex when we lose a limb. And now, whereas there is still a potential that this surgery could be reversed, in that it's still potential this week that any of this tariff policy could be reversed, which of course cannot occur in the case of losing a limb. I suggest we have to think in imagery around losing a limb and how we rehabilitate the body now to cope with that lost limb. As we know, in medicine, there can be prosthetic limbs. There is, however, a significant period of rehabilitation needed in order to learn how to work with that prosthetic limb. It's never quite the same as the original limb. And certainly at the moment of operation, there is a sense that life will never be the same again. And I would also liken this very drastic surgery to what occurred in the aftermath of the tragedy of 9/11. And we know that then we had to put in place stark measures around airline security, etc. And we've now got these measures in place, and we've never reversed those measures. Flying has never been the same since the tragedy of 9/11. So I would suggest that trade, building links with suppliers, will never be the same again. It doesn't mean that we cannot have a pleasant experience and have a profitable experience in doing the trade, but it is going to be a seismic shift in how partnerships are built. And we're going to see a very long aftermath of this shock, even if it is reversed, because I think we now know that economic operatives have seen that it is something like this is possible. The unimaginable has occurred, and something that was perhaps taken for granted, like a limb, like being able to fly without having liquids declared, is now no longer the case. And what is no longer the case? That we can rely on cheap supply from Vietnam and China, that these supply chains can be robust. I would say since COVID, we've learned a little about diversifying supply chains and building in alternatives and workarounds and nearshoring, etc., but not in the way that perhaps has made them completely like a switch that can be turned on once we've seen something very severe. So now we look at how we learn to walk again in the aftermath of this very severe amputation that we've seen in our medical situation. So where do we go from here? Last week I spoke about what is likely to be the immediate repercussion of the tariff move. We are likely to see falling output, and not only due to uncertainty, but due to simply an inability to source the same way, and a need to source, especially if we have, say, small businesses that source from China, a need to find alternative sources that can secure something profitable for that business. That's going to take time. We've already seen, particularly in Michigan, around some of the auto manufacturers, rising unemployment, as we know that there will be furloughs, there will be projects put on hold, plants will be mothballed, pending knowing where we go from here. Higher inflation is inevitable, I believe. Yes, it's true that some companies have stockpiled inventories in advance of these tariffs and will absorb initially the price increase. I don't think it's possible for something as stark as this, a 50% tariff in some cases, to be fully absorbed, and that will be passed through. There will be higher inflation, not only of imported goods, but also of domestic goods, as they know they have the pricing power and they're in a less competitive environment to set the price higher. And we do know, and we're already experiencing this, significantly higher economic stress the stress not only of markets and value being destroyed and wiped out in the last few days, but the stress of uncertainty and really dealing with the unimaginable. And that is a reality that is with us. Where do we go from here in terms of portfolios? It's safe to say I showed the Trump trade that we have had in place as a kind of a construct or a rubric since July of 24. So we have been preparing for a Trump administration for some time. And that means a balanced portfolio. It means having a portfolio that was globally diversified and not fully dependent on one region. It means having inflation hedges and resilience built into that portfolio, even when it seemed that inflation was coming in to heel and into check. What are inflation hedges or inflation participating assets? Things like real estate, infrastructure, and even equities themselves are a loose inflation hedge. Infrastructure has been a core of all of our portfolios. It hasn't been the most exciting asset class as tech stocks have dominated. But however, if we think about the industrial focus that President Trump is taking, infrastructure, the lack of spending on infrastructure to date, the need for more spending, that all translates into a positive outlook for infrastructure. We know, despite the current fall in the oil price and the current maybe fall off in demand for growth, that there is still going to be a strong demand for energy, and that anything that's a source of energy, we will need both fossil fuels as well as renewable and alternative sources. So there's still a strong demand there for infrastructure. Cash, we've had some balances in cash, knowing that it hasn't been a drag on portfolios, and gold and other hedges have been in portfolios and sort of creeping into portfolios all along, maybe not explicitly in our client portfolios, but they certainly have been forming a part of other managers' portfolios. I would say now is the time to rely also on the partnerships that we have built, particularly in the private asset side, where we know that partnerships are key because manager skill is so important. These are unprecedented times, but if we trust our partners to put our interests as clients first, we should be able to trust them that they will do the right thing in terms of that portfolio, in terms of staying the course, ensuring that it is resilient, and attempting to navigate these markets as well as they can. If we think about some of the nuance that hopefully these trusted partners have already incorporated into their portfolio, those that rely on supply from trading partners hopefully will have built up inventories in the expectation of some change, maybe not this drastic change, but some change coming up. We know that supply chains being more diversified is a lesson from COVID. We would hope that some of these partners have taken the precaution of having supply chains diversified from more than one supplier, more than one country. When it comes to the private credit, the lenders in our portfolio, another lesson from COVID has been what was sometimes sort of humorously referred to as the culture of amend, extend, pretend. We know that there were not many defaults because there had been a pattern of working with borrowers to work through some of their ups and downs and not trigger a default. Some of that was technical. We did not have the covenants in place that would trigger a default, but we also knew that even if there were not if covenants had been tripped, that if there was some kind of a workaround possible, or if that there could be a partnership in place with a borrower and lender, forcing a default was probably a worst case scenario. So I would suggest that this, again, this flexible approach, amend, extend, pretend, if that is undertaken by our borrowers, we will allow by our lenders, we will allow the borrowers to be able to survive this turmoil and long enough to be able to emerge at the other side with a more resilient set of suppliers and supply chains. And I would say equally with our partners, they will not be seeking to compound the big bang effect of the recent tariff announcement. We suggest that they, if they are sensible and wise, will try to minimize uncertainty, take a steady hand, take no knee-jerk reactions, and ultimately try to maintain a sense of calm in a portfolio. And that's what we are going to be relying on our investment partners to do. So that is a short update here on Monday morning, and we know it's going to be a tumultuous week. We've already had indications from Asia and Europe that there is a lot of market volatility increasing. So far, it doesn't seem like the markets have reacted quite as severely as the underlying future markets have. To add to some of the confusing effect, we know there is still a bid from some retail investors to buy the dip. That has been persisting throughout many of the dips we've seen in the recent 18 months. That could still be a factor, and a sense that some of the stocks have simply been oversold indiscriminately could still be a factor. But I would say this is, again, a time to stay steady, to listen to investment partners, and to try not to induce more uncertainty by taking knee-jerk action at a time that there have been already significantly big bang impacts on markets, and markets are understandably reeling as they reckon with that. Thank you very much, and I will see you at the end of the week at our live podcast in Baltimore.